Good morning. Today is Thursday, September 8th. I'm Joe Terril, president of Terril & Company, private wealth managers in St. Louis, Missouri. And this is another update on our outlooks on the world economy as well as investment markets. Since our last video, the Federal Reserve Bank has announced, the United States Federal Reserve Bank, by the way, has announced that they are going to fight inflation by aggressively raising interest rates in the next 12 months. In the meantime, countries around the world are also raising interest rates to battle worldwide inflation. Yesterday, Canada raised by 0.75%. Today, the Bank of Europe raised by 0.75%. And later this month, we expect the same thing from the Federal Reserve Bank of the United States. That increase would bring Fed funds up to the 3 to 3.25% range. So we have been saying for quite some time that we expect interest rates to move higher, and this is what's happening in the investment markets. And the event that we're looking for is longer term interest rates to move up. There is a belief in the markets that interest rates are going to go up, but they won't stay up very long, and therefore people are willing to buy 10-year bonds and etc. at 3.35%. We believe they are wrong, and interest rates on the longer end are going to move up closer to 4, 4.5, and even 5%. When this happens, the carnage that's occurred in the fixed income market so far this year will get even worse. Thus, our first outlook for investment markets are bonds and fixed income. You must stay very short in maturities. You must keep your duration very short. You do not want to get locked into an interest rate while rates continue to move higher. The idea that inflation is going to automatically come under control and we'll see inflation move back down sharply, and therefore the Fed will not have to be as aggressively as what they're talking. Again, we don't believe that either. Inflation is going to stay up in the 5 to 6% range. Thus, the Fed will be forced to do what they're telling us, and that is continue to raise interest rates to try and bring inflation down. As it relates to the stock market, markets have been very volatile. There again is a thought process out there that, well, the interest rates are going to move up, but they're not going to stay up for that long, therefore buy stocks. No, that again is not the correct approach to equities. Equity prices will continue to be revalued lower simply because interest rates are going to go up, and they're going to stay up for a couple of years. Thus, stock prices are not going to have a big rally and go back to new highs because rates are going to go up and then somehow automatically come back down. In addition to it, corporate profits are much more under suspicion as to what they'll be in the next 6 months than what the market is giving credit for. The market sort of believes that companies can continue to maintain their profitability in the face of higher costs for materials, higher labor cost, higher cost of capital, higher cost of transportation. This is not what we heard companies say when they reported second quarter earnings. Almost all companies are talking about how much their costs are going higher. Therefore, profit margins in the next 6 to 9 months for companies will be shrinking, and consequently, as multiples times earnings have to come down and corporate profitability is flat, we don't see the 10 or 15% growth in profits that people expect. That's not a positive environment for stock prices. So overall, we remain very cautious. All of the events we've just talked about, in addition to it, we have to worry about, will we end up with a recession? What's going to be the worldwide consumer psychology as this happens? Will consumers retrench and we'll have a recession, or are they going to continue to spend money and we'll have a strong economy? That doesn't make any difference, truthfully, on valuations for stocks and bonds. So, and the reason for that, of course, is capitalization rates are going to have to go up, which means multiples come down, and the corporate profits are very suspect. We would be pleased if they just stay flat with last year. Certainly the expectations for higher corporate profits, in our opinion, are unfounded. So the overall approach continues to be one of caution. We believe that as this year end progresses, we'll get some nice buying opportunities. Tax loss selling season for mutual funds ends October 31st. Mutual funds historically like to sell losers so they don't have to show them on their year-end report. There are a lot of good company and stocks that are down in price this year that we think will be even lower in price as the year goes along, as institutions and to a certain extent individuals by December 31st sell these companies for tax loss purposes and or because they don't want to have to show them in their portfolio. So we're not anti-stocks, we're very much pro-stocks, and we believe they're the best wealth building tool that a person can use over the course of time. However, it doesn't mean you can buy stocks anytime you want and or that stocks are always a good buy. No, you must be very careful and make sure you buy stocks at the correct price and that you don't overpay. When you overpay, you may sit 2, 3, 4, 5 years waiting to get even. So we think we're going to get some nice buying opportunities in stocks. We are still very bullish on commodity prices, whether it's steel, oil, fertilizers, soybeans, corn. Prices are down currently off the highs, but we believe that those prices are going to stay up, and if anything, they're going to rally back. The wild card in all of this is, what will the Federal Reserve do if there's any type of economic contraction? Will the Federal Reserve Bank lose their nerve and capitulate and go back to printing money? We certainly hope not, but we have a history here of the Federal Reserve Bank talking one way, and then when the heat comes into the kitchen, so to speak, doing something completely different. So we'll be monitoring that to see what happens. And the prices of speculative things are all down, and they will continue to go down. Cryptocurrencies, to a certain extent, aggressive real estate. those prices will also come down. But in general, commodity prices will stay firm. We're not going to see oil crash back down to $50 or $35 a barrel, and we remain bullish on energy investments. So I thank you, Brian Curtis, for helping us produce our video, and we'll be back in another 3 weeks with an update. Thank you and have a nice day.